So we've got a question here where we're going to solve for the statement of financial position, but we're also going to then complete the statement of cash flows. We've got a bunch of requireds here, but let's get started on one. Prepare the statement of financial position as it would appear at December 31st, 2000 X3. So we have 2000 X2 right here. We've got a bunch of information. And then we've got during 2000 X3, the following occurred. So we're going to have to determine what is the impact on these accounts from all the things that have happened during 2000 X3. So we're going to do some adjustments here. And we're probably going to need more than one column. There we go. Okay, so first it says they liquidated their fair value net income investment portfolio at a loss of $5,000. So we know that what they must have done is they must have done a debit to cash because they would have received cash from selling this investment. They must have done a debit because there was a loss on sale of fair value net income investment. And then they must have credited their fair value net income investment. So we know when they credited that, they got rid of 100% because it said they liquidated. We know that they had a loss of 5,000. So that means we can calculate the cash received, and the cash received was 27,000. Now I know that there must have been a negative here of 32,000. Now I'm not going to make any changes to retained earnings because they tell us here the net income was 35,000. So they've already made these adjustments. They also tell me down here the cash balance. So they've already done some things to the cash balance. Lots of stuff was probably going in and out. So I'm not going to take that into account. I'm just going to focus on what's changing in these accounts. And right now, if I look at this total, they have $0 here. And that makes sense because they liquidated their investment. A parcel of land was purchased for $38,000. So they must have done a debit to land and they must have done a credit to cash. And that would have been for the full $38,000. So that means their land must have gone up by $38,000. All right. An additional $30,000 worth of common shares were issued. So they must have done a debit to cash and a credit to common shares. And that would have been for the full amount of 30,000. So common shares are going up by 30,000. Dividends totaling $10,000 were declared and paid to the shareholders. You got to think that would have been a debit to dividends and then a credit to cash. But we also would have closed that dividend account at the end of the year to retained earnings. So we would have done a debit to retained earnings and a credit to dividends. So that was for $10,000. There we go. And that same $10,000. So that means retained earnings must have gone down by $10,000 right here. And again, we know that there was changes in cash, but they give us the cash balance at the end. So we're just going to ignore the cash. And of course, the dividends went in and out. So there's nothing. Oh, I might as well just do a strike through of these because I finished them. There we go. Now, net income for 2023 was $35,000, including $12,000 of depreciation. So they must have done a debit to depreciation expense and a credit to the accumulated depreciation, which it's net here. Equipment is net. So they've taken the accumulated depreciation and simply net it against the equipment account. So I'm just going to note that this is going against the equipment account. And that was for a total of $12,000. So over here on the equipment, I'm going to deduct the $12,000. Now, since they had income of $35,000, there must have been a debit to the income summary to clear it out of the income summary and a credit to retained earnings. And that would have been for the full $35,000. So over here for retained earnings, we're going to add in the $35,000. Now, remember, I'm not doing anything with this because this is already included in the $35,000. So there we go. Got rid of that. And then land was purchased through the issuance of $30,000 of additional bonds. Well, that means we must have done a debit to the land and a credit to the bond payable for the $30,000. So land is going to go up by $30,000 and the bonds payable are going to go up by the $30,000. Excellent. G. At December 31st, 2000 X3, cash was 70,200. So we know the cash is 70,200. That means it must have been adjusted throughout the period by 50,200. They show that accounts receivable were 42,000. So this means if we take the 42,000, this must have increased by 20,800. And then they show that the accounts payable was 40,000. So if we go over here, and that means the adjustment must have been an increase in $10,000. I can do the rest by simply adding across. And then I want total assets. So I'm going to add up all the assets. Total assets is $289,200. Now, if I've done this correctly, when I add up all the liabilities and the equity, it should equal the exact same amount. And it does. So that's perfect. So we finished everything. All the items we were going to deal with, we dealt with. So now let's go down here, prepare the statement of financial position as it would appear on December 31st, 2000 X3. Well, of course, what we would see is we would see the company name, which is Arrow Inc. I'm just going to copy it. The statement of financial position. And then what we're going to see, of course, is at December 31st. And now I'm going to, of course, do assets, current assets. And for the current assets, I need only the cash. Next, I need the fair value net income investments because they're more liquid than the accounts receivable. And then I do the accounts receivable. And then this will be total current assets. And let's just get those amounts. Remember, I've got 2000 X3 and 2000 X2. So over here, I've got the cash for 2000 X3. I've got the investment for 2000 X3, and I've got the accounts receivable. And then for X2, I'm going to put in the 20,000, the 32,000, and then I've got the 21,200. And the total current assets will be added up. There we go. Just going to underline this. So that's our total current assets. I also have property, plant, and equipment. And that will start with my land. And then I'll do my equipment net. And so over here, I've got the land and the equipment net, and the land and the equipment net. Adding both of those together, this will give me total property, plant, and equipment. There we go. And then we're going to do, of course, total assets. Current plus my non-current. And there is our total assets. I'm going to double underline them. There we go. So now, of course, I have to do the liabilities and equity, also called shareholders' equity. And I'm going to do the current liabilities. And I'm going to start with the accounts payable. Bonds payable are long-term. So I only have my accounts payable of 40,000 and 30,000. There we go. I don't need a subtotal because I don't have more than one account. I'm going to do non-current liabilities. And that is, of course, the bonds payable. And I've got the 71,000 and then the 41,000. Again, no subtotal necessary because there's only one account. I'm going to do total liabilities. There we go. Just going to put a single underline here. And now I have equity, also called shareholders' equity. I need my common shares and then my retained earnings. I'm just going to copy this down. There we go. Single underline. Going to do total equity. And then a single underline here, and I'm going to do total liabilities and equity. And that will better be the same amount, and it's identical. I'm going to double underline this. So here is our statement of financial position. This is, of course, a classified statement of financial position, which we are required to produce under both IFRS and ASPE. So there we go. And we've finished. Awesome. So now moving on. Prepare a statement of cash flows for the year ended December 31st, 2000 X3 using the indirect method along with any necessary note disclosure. Assume dividends paid are treated as financing activities. So let's go over here. We're going to use this to do the statement of cash flows. We'll use the comparative statement of financial position. So we know in order to do a statement of cash flows, we've got to calculate the change in any of the accounts. So I'm going to do that. And of course, the change, and I'm just going to do a little note here. For all the debit accounts, we're going to use the formula prior minus current. So that's the prior year minus the current year. And for all the credit accounts, we're going to use the formula of current minus prior. We never apply the formulas to either cash or retained earnings. Short form RE for retained earnings. So in this case, remember it's prior minus current and prior minus current. We never apply any of the formulas to totals or subtotals. So I'm just going to eliminate all the totals and subtotals, which I just spent time creating. But I'm going to do this because I cannot apply any of these formulas to totals or subtotals. And by striking them through, it just reminds me that I'm not allowed to use these formulas. So this is prior minus current. There we go. All right. Now, for all the credit accounts, I'm going to do current minus prior. So over here, I'm going to do the current minus the prior. There we go. Current minus the prior. Current minus the prior. And of course, we're not allowed to use this formula for retained earnings. Instead, we have to do a retained earnings proof. So we do the retained earnings proof. That starts with the opening retained earnings. We're going to add in the net income. We're going to do a minus dividends. And this will be the closing retained earnings. So the opening retained earnings, of course, comes from the prior year's retained earnings. We know what the net income was because they told us the net income from the income summary was $35,000. So we have the net income. We actually know what the dividends is, but I'm going to pretend that we don't. So I'm going to go down here and do the closing retained earnings, which allows us to calculate, of course. I'm going to subtract the net income and subtract the opening, and it's $10,000. This is dividends paid. And we know that this is a financing activity, and it's going to be a negative. It's going to impact the cash flow with a negative because, of course, cash has flowed out when we paid the dividends. So I'm just going to highlight this, and I'm going to use green for all financing activities. So we've calculated this. Perfect. And now we have to determine, can we use all of these things, or do some of them need to have a T account proof or some kind of proof? We already know that the fair value net income investments, we can't use the formula here. And that's because we know that the actual thing that happened was not $32,000 of cash. We ended up with only $27,000 with cash. So I'm going to copy this. I'm going to paste it over here, and I'm going to use it for my cash flow. I'm going to paste special. All right. So we know this is the sale of fair value net income investments. Which activity does it belong in? Is it operating, investing, or financing? And most people would put investing, and that would be incorrect. We have to put it down as operating, and it was an inflow. Now, why are we doing it as operating instead of doing it as investing? And the answer is that investments which are held for trading, so they're held for trading securities, which fair value net income investments are, because they're held for trading, they're there to generate revenue, part of the regular business. And because of that, these are classified as operating activities, not investing activities. So I'm going to highlight this with an orange. I also have this loss on the sale of the fair value net income investment, and that loss is on my income statement, and it's non-cash, right? It has nothing to do with cash. And because of that, I have to remove it from the income statement. So this is going to be the loss on sale of fair value net income investments. And this is going to be an operating activity. A loss is a negative. I want to eliminate it. So I'm going to put a positive against it. So this is also orange. Okay, so we've dealt with this, and I've gotten rid of it. Accounts receivable we're fine with. Land, I'm not okay. So I'm going to get rid of this land. And the reason I'm getting rid of this land is I know two things happened to land. So I know that land was actually purchased for cash. So I'm going to copy this. I'm going to put it over here. So land was purchased for cash. Paste special values. There we go. So this is a purchase of land. And when land is purchased, I know it's an investing activity, and it was purchased, so it's going to be an outflow of cash negative. So I'm going to highlight this as an investing activity, and I'm just going to use yellow. I also had an other activity with the land. So when I look here, I've got land and the bonds. So copy. I'm going to put this over here. Okay, special values. This is a non-cash transaction that doesn't belong on our cash flow. So I'm going to highlight this in red, and I'm going to note that this is a non-cash transaction, and it's a note to the cash flow. It didn't result in an inflow or outflow of cash, so I don't put it on my cash flow statement. All right, so that's the land. Equipment, we know that this is actually depreciation expense. And depreciation expense is operating, right? And depreciation has nothing to do with cash, so we want to get rid of it to move the income statement from being accrual accounting to being cash accounting. So I'm going to get rid of it by putting a plus against it, and that will eliminate it. And it's operating, so I'm going to put it, again, operating is all orange, so I'm going to highlight this in orange. There we go. I keep going down. Accounts payable is fine. Bonds, we know bonds were changed. Again, non-cash items, so I'm going to eliminate it. I don't want to have this on my cash flow statement. And then the common shares, this is from issued common shares. This is, of course, a financing activity, and it resulted in an inflow. So it's financing plus, and so we're going to do a green highlight for the financing. All right, so there's still a few things that we haven't put anything against. We know that accounts receivable, the other side of the entry, is sales revenue. That's in the income statement. Anything having to do with the income statement goes in operations. So this is operations. I don't need to indicate whether it's plus or minus because it's already indicating whether it's plus or minus. I also need to know if accounts receivable have increased or decreased. I look here and they increased. So I'm going to put increase in. There we go. And now we've got this for orange. Okay, going down here, accounts payable. So when we look at accounts payable, the other side of accounts payable is usually operating expenses or it's inventory. Well, we know it's not inventory. It's got to be operating expenses. There's no inventory here, so we know it's got to be operating expenses. So that means it's operations, right? Because it's on the income statement. And what happened? We had an increase in, because we see it went from 30,000 to 40,000. So we had an increase. So now we know this goes under operations. So it looks like we have dealt with every single item. So we can now create the statement of cash flows for this company. So we're going to start with the company name. And we're going to do the statement of cash flows. Year ended December 31st, 2000 X3. Okay, we're going to start with cash flows from operating activities. And this is indirect. We were asked, I'm pretty certain they asked us for the indirect. Yes. So we're going to start with net income. And we already know what net income is because we've had it. We've talked about it. It's 35,000 right here. And it's 35,000 right here. So it doesn't matter where we get it. So we've got net income. And now we have adjustments to reconcile net income to net cash provided by operating activities. So no particular order. I'm going to just start with whatever I happen to have. So I have an increase in accounts receivable, and that is, and you know what? I'm going to move this over one. There we go. So that is this negative $20,800. So I've used this up. I'm going to do a strike through to get rid of it. Now, I also have depreciation expense operating plus. So I'm going to do 12,000 there, and I can get rid of all of this. I've got an increase in accounts payable, and that's going to be the 10,000. So strike through this. So I'm looking for other, I have the sale of fair value net income investments. That's operating plus 27,000. And I have the loss on sale of fair value net income investments. And that's a loss, so plus against it. There we go. So that looks like all of the items that I have marked. I'm going to put strike through. There we go. So in that case, I have net cash provided by operating activities. Now, first, I want to put this total right here. There we go. And we'll put an underline. Let me move it over a little. And so I'm going to add these two numbers together, and that is going to make 68,200. So that is the cash that we have received from running our business every single day. Let's move on to cash flows from investing activities. So remember, we have from investing activities, we have, what do we have? We have the purchase of land, and it was an outflow of $38,000. I don't think there's anything else. Because we only have one, we don't technically need to have a total, but I'm going to do a total. It's not going to lose you marks to do a total. I'm going to say net cash used by investing activities. And over here, we're just going to do the exact same amount, right? We're going to do a line under this. There we go. You don't have to. You could have just moved this over, because if you only have one line item, you don't have to have a subtotal. So now I've got cash flows from financing activities. There we go. And did I do a strike through? I totally neglected to do a strike through, so I'm going to do a strike through now. So over here for financing activities, I've got the dividends paid. This is a negative 10,000. I'm going to do a strike through. And now I've got my issue of common shares, which is a positive. And this is going to be the net cash provided by financing activities. Just do a line under here. And I'm going to add these two together. Okay, so now a line under here, because I'm going to do the net increase, decrease in cash, which is, of course, all three of these amounts added together. This is going to be an increase of $50,200. I have to have the cash at beginning of year. And I get this from my statement of financial position. Cash at the beginning of the year was 20,000. There we go. And this will be cash at end of year. If I add these two amounts together, 70,200. If I've done this correctly, we know it will equal the exact cash that is in the 2000 X3 statement of financial position. And there it is, 70,200. So here is our cash flow with the proper format. I'm just gonna, because I'm neurotic about things like this. There we go. And we got it. There's our cash flow. Now, the only thing we have to do is we have to do a note. So we would say the company purchased land at a cost of 30,000 in exchange for additional bonds payable. And we should also note disclosure for cash paid for interest and income taxes would be noted at the bottom of the cash flow statement. Now, just be aware, right? Put it down here as an aside. We have to disclose the cash paid for interest and income taxes. And that's not being disclosed here. This has to be disclosed. And we don't have that information for this question, but just be aware that that's a disclosure that is required. All right. So we just finished 2. 3. Calculate the current and acid test ratios for 2000x2 and 2000x3. So let's just transfer this down here. I'm just going to copy it. The current ratio is current assets divided by the current liabilities. Let's just center them, and then I'm going to put the little divider. There we go. All right. Now, the acid test. This is specific current assets only. So this is cash, cash equivalents. It's short-term investments. And it is also accounts receivable. And it is all divided by current liabilities. Now, this is considered a more stringent measure of the company's liquidity. And the reason it's a more stringent measure is because we take out inventory, which might not be sold as fast as we think. And if we do sell it, we're going to sell it for liquidation value, which is going to be a lot lower than the actual value that we're putting on our financial statements. So this is a more stringent measure of liquidity. So when we look at current assets here, and I'm just going to use the statement. I know I struck through a bunch of stuff, but we can still use it. So if I look at the current assets right here, divided by the current liabilities right here, this is, of course, for 2000 X3. I can do it for 2000 X2. So I'm going to do the current assets and the current liabilities. There we go. And I might want to just move this over one. There we go. So what does this show us if we're looking at this ratio? Is the trend an improving trend or a worsening trend? And we can see that previously we had $2.44 for every $1 of liability. And now in 2023, we have $2.81 for every $1 of liability. So even though our liabilities went up by $10,000, our assets, our current assets, went up faster. And as a consequence, we have more liquidity. It is more liquid than it was previously because we have more current assets for every dollar of current liabilities than we had in 2000 X2. Now, notice that because the company has no inventory, their acid test is identical. So we don't actually have to calculate the acid test because there is no inventory to eliminate. And as a consequence, these ratios are identical. Usually they wouldn't be if there was inventory, but they are right now. Okay, so moving on, number 4, calculate the company's free cash flow and the current cash debt coverage ratio for 2000 X3. So let's do that right now. So free cash flow from operating cash flow is calculated as net cash provided by operating activities minus any capital expenditures minus dividends, all divided by the cash flow from operations. So that's how we calculate it. Now, this ratio is very different than normal ratios, and here's why. What we usually do is we take the cash flow from operating activities and we compare it to the income statement. So that's what a lot of ratios do. But we're not doing that here. Instead, what we're looking at is the amount of cash that's available to investors, right? Comparing it to the cash from operations. So we know if there's capital expenditures, these amounts of cash are no longer available to the investors. And dividends, because they've already been paid out, are no longer available to the investors. So we're taking the cash flow from operating activities and we're removing the cash that is being used to continue to grow the company and being used to pay back to the investors. And we're saying, okay, how much is now left for the investors? How much is left after these two things have happened? Now, what happens if this ratio is high? If it's high, it indicates, because the highest it could be is 1. Because we have 0 expenditures and we have 0 dividends. That would be, of course, the cash provided by operating activities divided by the cash provided by operating activities. So the highest it can be is 1. If it is 1, it means that the company is not investing in the future growth of the company, and it is not giving any dividends back to the investors. Keep in mind that this ratio changes depending on how mature the company is. A very mature company probably doesn't have as many capital expenditures because they've already invested in the company. They're mature. They've built their infrastructure. They've built all their facilities and all the rest of it. And so probably their capital expenditures are going to be lower. Now, if it's a brand new company and they're just beginning to build, you got to think that their capital expenditures will be very high. Their dividends probably are going to be low, but their capital expenditures are going to be very high. So be careful when you're doing this calculation and comparing it between companies within the same industry, because you have to look at the age of the company in order to properly compare them. So let's do this calculation for this company right here. So we've got the cash flow from operating activities, which we see right here is 68,200. We're going to subtract any capital expenditures, and we're going to see capital expenditures were $38,000, right? And then we see that we also paid dividends. So the dividends were 10,000, and we're going to divide it, of course, by this. And this will tell us very quickly what the ratio is. So it's 0.30. Now that's the ratio. We could also just look at the free cash flow as a number, which is 20,200. But changing it into a ratio is better because it allows us to compare different companies of different magnitude, different sizes. You can't do that if you just look at the 20,000. So we can see that it's 0.3, so it's quite low. That's because they've made large capital expenditures into growing their business, right? And paid dividends to the shareholders. All right. We were also asked to calculate the current cash debt coverage ratio. So let's look at that formula. Now, cash debt coverage ratio is calculated as net cash provided by operating activities divided by the average current liabilities. Now, average current liabilities are calculated as current liabilities at the beginning of the year, current liabilities at the end of the year, divided by 2. This ratio tells us if the company will be able to pay off their current liabilities with the cash flow they receive from operating activities. So let's calculate it for this company. We already know the net cash provided by operating activities is 68,200. And the average current liabilities. So we take the current liabilities at the beginning of the year. Just looking for the current liabilities. There we go, which is 30,000. We're going to add it in to the current liabilities at the end of the year, which is 40,000. And we're going to divide all of that by 2. And keep in mind, we're going to put this right here. I know it looks a little confusing, but it's really not. There we go. So now I've got the 68,200. Take the 30, add in the 40, divide it by the 2. There we go. And now we look at this ratio. So this is 1.95 to 1. What does that indicate? For every $1 of current liabilities, we have almost $2 of cash flow from operating activities. So this ratio is very high and it's very healthy. All right, let's look at number 5. What is the cash flow pattern? Discuss the sources and uses of cash. So let's just look at this question down here. Now, let's go across to the cash flow and look directly at the cash flow. So what do we see? We see that there is a positive inflow from operating activities, a negative outflow from investing activities, and a positive inflow from financing activities. So what does that say to us? So it says that this company has more than tripled its cash balance from one year to the next year, from 20,000 to 70,000, right? And they've managed to do that mainly by the cash that's being generated from operating activities. Remember that operating activities is the only sustainable source of cash. So this is a very good thing. They have paid quite a good amount of dividends, $10,000. And they've managed to obtain some external financing in order to invest in land. And they've also obtained some cash, of course, by selling off their trade investments. So they've had a very good inflow from their operating activities. And again, only sustainable source of cash. Now, I would say one of the concerns probably, if we look at the statement of financial position, we can see an astronomical increase in their accounts receivable. This is a little bit alarming because unless the increase is really supported by an increase in sales, or maybe they changed their credit policy, this means that they're no longer collecting the cash that they should be from their customers. So I would definitely want to investigate why there's been this increase, because that increase here, and so that's a concern. We need to investigate that, because if this trend continues and it's because we're not managing our accounts receivable, then our cash flow from operations is going to decline next year. So that's what we're seeing. We're seeing a good increase here. We've seen investment in the company, which means we expect revenues to continue to increase. If we invest in the company, we do so because we want to generate more revenue. And we've managed to get financing for it from outside. Let's look at the last question. Question number 6, use the analysis of this company to illustrate how information in the statement of financial position and the statement of cash flows helps the user of financial statements. So I'm just going to copy this down here. All right, so let's start by looking at the cash flow statement. So this is useful to the users of the financial statements because it indicates exactly where cash is coming from and what it is being used for. And that's a critical piece of information for users to predict what may happen in the future. Basically, the users can use it to determine the amount, the timing, and the uncertainty of future cash flows. And keep in mind, it's showing users the flow of cash. So where is cash coming from and where is it going to? In addition, some users want to know about the quality of the earnings because the measurement of net income is accrual accounting. And there's a number of accruals and estimates that are included in this number, which are basically subjective. That means that having information on the net cash flow provided by the operating activities, they can then use this to calculate ratios about cash and the cash provided by operating activities in comparison to the net income on the income statement. Keep in mind that information from the statement of cash flows can be used to predict the future, to get some idea what may happen in the future. And that can be used by users in order to make decisions about what they're going to do with the company's shares, or if it's a creditor, with lending money to the creditor in the future. Now, keep in mind that the statement of financial position, also called the balance sheet, gives information to both the investors and creditors with regards to financial condition of the company. This is really talking about the financial health of the company. They've got their assets. How are they funding all those assets? Is it through debt or is it through equity? It gives information about liquidity, the company's ability to pay off their short-term debts as they come due. And finally, solvency, the ability to pay off their long-term debts as they come due. There's a lot of ratio analysis that can be done on the statement of financial position to provide information to the users of the financial statements. That's it for this question. Hopefully, it was helpful.